Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. I hope you've all had a smashing Monday so far. It is a new week, and of course that brings new opportunities, and we're potentially going to get into some of those within this video. This is going to be our daily cryptocurrency market update. We're going to start by talking about Bitcoin, looking at the overall market, and then we're going to be recapping and touching where we left off in yesterday's video. We did an interview with the market sniper, Mr. Francis Hunt, where we spoke about the yield curve and why this may bring some cause for concern. And I think people got very worried by this. I think when you don't understand what this could mean, it can be quite a scary concept. However, you know, crypto is the new thing. And yes, the economy as a whole, it's why we've maintained the cautiously optimistic view, is not doing so well. You've got this yield curve, and the yield curve, a negative yield curve between the 10 and the 2-year treasury notes, has essentially always signaled a downturn coming. It's a lead indicator for a recession, and it's accurately called recessions previously. Whether that be you had one of these just before the March 2020 event, you had one I think 5 months before, and then you had that capitulation event. You also had one before the 2008 financial crisis, the dot-com boom, and of course the crash of '89. So we're going to get into it all in this video, recapping on this, going over a number of things in association with it, also showing you on the Dow Jones and the S&P, when these yield curves actually occurred and then what followed, and are we potentially setting up for a similar thing today? Well, we have historically played out in that manner, so there may be credence to it playing out again in a similar fashion presently. So let's start by looking at the overall market. The markets are somewhat consolidating, going a little bit sideways, not really doing a lot. And we did say that this was a very likely outcome. You guys know that we've been watching, and I'll very quickly highlight again to show you this, the MACD bullish cross, which we had, which is typically a signal that you get before you get more continuation. But quite commonly with this MACD bullish cross, you do see a period of consolidation before you get that continuation. And I'll highlight just a few of these to show you that, you don't typically get this signal and then go straight up. You can see, if you look, very common that you'll get the signal, you'll get this MACD cross. This one was a bit of a kind of double one. This was the original one that took place. You can see you do get a period of consolidation. This, of course, was March 2020, which was a freak event. If we go back prior, you can see that your sort of MACD crosses lead to consolidation before continuation. So that's what we're expecting on balance of probabilities. We are expecting that further continuation for crypto, but we have been kind of anticipating a kind of consolidation event after we've seen such an impressive move up for Bitcoin from the lows to current day. We're still up 37%, which is significant. It's quite normal. And certainly if we take it to the top of the impulsive move, it's quite normal to kind of see a retracement before continuation. That's very healthy structure, in fact. And you're at a very significant level for Bitcoin. This sort of 48, 47K range is extremely significant, certainly in the last year or so's history for BTC, and is really a deciding factor. We want to get above it and convincingly stay above it. And then you'll be kind of, making headwind on this structure over here, and potentially setting up for new all-time highs. That's now going to bring us on to what we spoke about, or what me and Francis roughly touched upon already. Francis touched upon in yesterday's video, and that is, of course, the yield curve. And the yield curve, very quickly, is when your smaller yields, your smaller bonds. So, for example, here we've got the 2-year, with the 10-year and the 2-year. When the 2-year offers a higher yield than the 10-year, that's when you have essentially it's almost like a voting mechanism, in the sense that it really indicates that there's a huge distrust in the economy, and people don't want to lock their money up for longer and go with a bigger bond because they don't trust things like inflation and the strength of the economy. So the 2-year actually overtakes the 10, and you end up with a negative yield curve, which is when you essentially go behind. This is the white line that I have for you. This is, of course, 0. And anything underneath is called a negative yield curve. And if you look historically at when we've had this, they've typically been a lead indicator into a recession and a downturn in the economy. And I'll show you guys this. But, this is the first one for crypto. It's not the first one because, of course, we had March 2020. But if it plays out in a similar way to March 2020, it's actually not a bad thing. Now that might, some of you might go, "What, are you out of your mind? How can you say that?" Well, if we go back to March 2020, that was your March 2020 event, and what happened after? Because the economy in general is in a very uncertain place. We've got monetary policy. We also spoke about this in yesterday's video. They can't up interest rates to any kind of an inflationary crushing number. They just simply can't. They owe too much debt themselves to physically do that. Francis used the analogy of when you put your hand in a jar and you try and grab all the sweets, you just can't get your hand back out because, of course, you've got too much. You're carrying too much. And that's the same sort of thing that the Fed and many other governments around the world and central banks are currently facing. They can't physically pull their hand back out the sweet jar and kind of raise interest rates to any kind of an inflationary crushing stat because the economy just wouldn't allow for it, and you'd end up in some serious turmoil. So back to what I was talking about, March 2020, actually didn't turn out to be too much of a bad event for Bitcoin, and in actual fact, it really highlighted what Bitcoin was created for, to hedge against the dollar, to come up with a monetary system that can't just be inflated away by central bankers and their corrupt policies. And this is a little sort of summary. This is the date of inversions. You can see here, this is the 1988. You've got 1998, which of course the dot-com boom, and then you've got 2005, and you've got 2019. Now, sometimes, so for example, this was a lead indicator that was nearly 2 years long, or just less than 2 years, about a year and a half after you had the yield inversion. You then had the crash, or the peak of the sort of bull market. So it's a lead indicator. It can typically be a big leading indicator in the sense that you can have this inversion and then things can happen years down the line. But they do happen. It's a bad sign typically. So we're not calling for a crash today, tomorrow, or in potentially even the next 6 months. But what we are calling for is the fact that we may run into some turmoil at a later date, given what this signal has typically meant previously. And we'll show you that on the chart. So if we use this and we'll do the Dow Jones. So we'll go for 1988. Bit of a longer video today, guys, just because I thought it was really worth explaining this. So we go for 1988. And what month were we on? We'll do it roughly. And then we've got 1998. What month did we have that on? The 5th. And then we'll put them all on, guys, just to sort of show you this, and then we'll put one on where we are today. We've got 2005, the 12th. We'll go in November. And then we'll put, obviously, the most recent one prior to the one that we've just had, which was in 2019 on the 8th. This is the Dow Jones Industrial Average, by the way. So there's certain indices or certain indexes that are affected more than others, given, for example, your NASDAQ would have been more affected in the dot-com boom than, for example, the Dow Jones Industrial Average. But I'm just showing you this as a kind of way to show you, when these yield curves happen, what kind of ensues after. As I think people were, it's not, once you get your head around it, it's like everything, it's not that complex. So we've got the 8th, 2019. So that's not quite right. So these are when you've had your prior yield curve inversions. Some have been significantly worse than others. I'll do it on the S&P as well. But you can see typically, you peak out a little bit later and then you get a drop, a correction. And remember, 40% in the crypto market doesn't seem like a lot. But in regards to the Dow Jones Industrial Average and your sort of typical old-fashioned stock indices, it's huge, guys. I mean, a bear market, they call a bear market at 20%. You can see after that one, we then ran into a 55% 8% recession. Of course, that's 2008, which was when all of this started, why Bitcoin was created. And of course, you had the one in 2019, which of course led to the March 2020 crash, which went down 38%. And of course, crypto got hit a lot worse. So these yield curves, and we've had one essentially today or a couple of days ago, these yield curves typically signal a bit of an issue. And when we had the last one that led to March 2020, that didn't take too long to come to fruition. It didn't take too long. If you look previously, we've had the yield curve inversion, and then things have, taken a little bit of time to play out. Markets have continued to sort of go up before peaking, and then we've seen the drop. Some of them take 2 years, or typically a little bit under 2 years. Whereas the one that led to March 2020 happened in only 5.8 months. It only took 5.8 months for it to kick into effect. So there's almost this compressing, and you can kind of see that within these kind of yield curves. There's almost a kind of compression of it. And this is absolutely, this is coming down in more of an aggressive manner than previously. So that's why, one of the main reasons, and I'll do it just for argument's sake, guys, this is really the bulk of the video that I have for you guys. I was going to go over quite an interesting tweet in just a second, but I felt like this would be hugely beneficial when we're talking about the yield curve, and it kind of alerts you guys to why I'm cautiously optimistic. I think crypto is the future. I think blockchain technology is on an adoption curve that it's very early on, and I think it's going to do very, very well out of it. I think, when we look at our market cap, we're in the $2.1 trillion. I think we can get to the tens, if not hundreds of trillions into the future. And I think that is a reality that I'm certainly looking at. I do genuinely believe that blockchain is a technological revolution that is going to change the world in a similar fashion to, what the internet did, or the PC revolution, or the telecom revolution, or the motoring industry. These are all technological revolutions that have changed our lives and we all use on a day-to-day basis. I don't think blockchain's any different. But what I am saying right now is we've had this yielding curve inversion, guys. It's time to sort of watch out, maybe be a little bit more cautious. Francis gave some advice not to use leverage for the traders out there. I wouldn't recommend, if you're not a quick trader, to use leverage full stop. It's a very easy way that these exchanges basically harvest retail. What I'm going to do is we'll do this again on so this was called the Dow Jones. We'll do it on the S&P. Those of you that have sort of got the message, you don't need to watch this bit. I just, really want to kind of emphasize what I'm trying to highlight here to show you that why this is a kind of an issue, if you will, and something to keep an eye on. So we'll do it again. So 1988. What was the actual date of that? The 12th, 1988, the 12th. You can see you do have a period of sort of down side and sort of, not really much continuation at all. And we'll do the next one, which is 1998. I think it was about the third, maybe. This is not exact, guys, but I'm sure you're getting the message with what I'm trying to highlight here. That it's certainly something to watch out for. And then, of course, we've got 2005, the 12th, 2005. And one thing this is doing, by the way, guys, is it's helping you guys get to grips with macro markets and things that affect them. And as crypto investors, many of you your first endeavor was in the crypto space. It's good to get acquainted with external markets, because they do definitely, and we've seen it increasingly as they've disturbed our kind of 4-year cycle theory and all the other models that we had, they increasingly are playing a role. And then we'll use 2019, and it was the 8th, 2019. So remember, this one didn't take long at all, but you can see, again, here you just had very low growth. Of course, all of these crashes have different themes. So the dot-com boom so the one that followed the 1998 one was, of course, the dot-com boom. 2008, the one that followed the 2005 one, was the financial crisis of the sort of subprime mortgages, the housing market. This, of course, was March 2020, which was 19. And then we've just had one that essentially could, we've also got the sort of Russia situation that's flared up. And is that going to lead to something? And the thing is, nobody knows when things are exactly going to top out because there's differing data here. But things do seem to be getting more compressed. And that's certainly something you've got to pay attention to. So long term, I think crypto is going to be fine. I just think, and everybody should sort of understand this that's been in the crypto space today, we're going to get a bit of volatility. And that's just kind of how the game goes. And that's, you know, and now that we've had this yield curve inversion, do we, for the first time, not follow it, if you see what I mean? Or do we sort of stick to the plan and we have more of a sort of, you know, we get yield curve inversion, then we get a recession folding afterwards? And it's hard to see from an economic point of view how we don't end up in a recession. I mean, it just doesn't make that much sense. And what is being highlighted here is, in actual fact, you know, you have the yield curve inversion, then you still see a rally. So we're calling for that. That's another reason why we actually think Bitcoin is going to see that continuation and do quite well, because of, you know, we still expect things to continue for a bit. And then there's an inevitable, I think, sort of slowing down and recession that's kind of lurching that you kind of need to pay attention to. So that is really all I have for you in this video, guys. It was just really a short and sweet one. Well, not a short and sweet one at all, but it's something that we mentioned in yesterday's video, was the yield curve inversion. If you want to find it, it's the US 10-year and, of course, the US 2-year against the US 2-year. And this is really highlighting, you know, it's almost like a voting mechanism for how well people think the economy is or isn't going to do. And when you get this inversion, it's typically not a good sign. It's not an impending doom by any means, but it does mean that, you know, a slowing down and potential recession, if not depression. 2008 was a depression, not a recession. You know, it could be on the horizon. And just remember how leveraged everything is at the moment. You know, we've got crypto, which is a new thing. Maybe crypto does well on the back of this. We just don't know. And how it's kind of acted at the moment is anything to go by, it doesn't really give us a lot of confidence that it's going to do extremely well in a kind of recessionary situation, because it's actually moved very much like the Nasdaq and a number of risk-on assets than a risk-off asset, which is what I was kind of hoping it would act as. This is an interesting tweet. There are currently 700 trillion of global investment assets like bonds, stocks, real estate, art, gold, and savings. If only a small portion of that finds its way to Bitcoin, 1%, it equals a 337k BTC. 2%, which of course equals 14 trillion, equals 667k BTC. 3% equals 1 million. Do you think this is possible? I could definitely see this happening, you know, because at the end of the day, people are in this kind of situation where do they put their money? You know, if you know you're going into a recession, where are you going to put your money? You're going to put it in gold, which actually hasn't done that well, given everything that's gone up. This should have been the breeding ground for an explosive gold. What are you going to do with it? But we'll maybe tackle some of these questions in a later video. If there's anything you guys want me to cover, let me know in the comment section. If you guys can leave me a like and a comment, it helps my channel out greatly. And I'll catch you all in the next YouTube video. Thank you very much for watching, ladies and gentlemen. I'll see you all in the next one.